In this week's video, we'll review the latest charts and studies to help us answer the question: will renewed risk appetite bring another leg higher in stocks? We've noted several times in recent weeks that the big wild card walking forward for the remainder of the year is Fed policy. In a recent survey of institutional money managers, 72% of the respondents basically said their biggest concern was Fed policy. It was either a taper tantrum or rising inflation. And those are basically one and the same. Those are the same topics. If institutional money managers have been concerned about a taper tantrum or a rapid change in Fed policy, it's probably fair to say some of them may have raised some cash in recent weeks and months. Friday's monthly labor report came in well below expectations. Expectations ranged between 700,000 jobs based on a Bloomberg consensus all the way up to 2.1 million. Came in at 266,000, which directly addresses the major concern of institutional money managers, at least in the short run. So over the past 5 trading sessions, have the present day charts become bearish? From a weight of the evidence perspective, the answer at this point is a definitive no. Is everything perfect? No. We can't expect everything to be perfect. But the big picture in terms of breakdowns still looks very, very good. These are charts that we covered in last week's video, SPY-TLT. Here's the same chart as of the close on Friday, May 7th. You can see we don't have any breakdown in price up here in the upper right-hand corner. And if we compare momentum down here to momentum here and here, this looks a lot better. And this speaks to expectations about future economic outcomes. Like everything else, this can change very, very quickly, but it hasn't changed yet. In this segment, we'll be talking about market expectations relative to economic outcomes, inflation, and interest rates, and more specifically, the yield on a 10-year Treasury. And in this case, when the copper-gold ratio has been rising, the market is expecting higher yields on the 10-year Treasury, higher inflation, and thus this also speaks to the attractiveness of risk assets relative to bonds. This is increasing risk appetite. This green line here is the copper-gold ratio. This is Bollinger Band. This is the lower Bollinger Band where my cursor is. This is the center line, and this is the upper Bollinger Band. Not surprising that inflation expectations were low in a rare manner in March of 2020. We have a sharp and rapid reversal here, and then the copper-gold ratio was able to close above the upper Bollinger Band for 3 consecutive months. Thus, we wanted to know, how many times has something similar happened dating back to 1982, and how did the stock market perform walking forward? The only similar case in our study period, 1994, specifically December 30th of 1994. And if you know your market history, you know the S&P 500 performed extremely well over the next 4 years from the end of calendar year 1994. And as we always say, keep in mind, these are not just lines on a chart. They're a reflection of human behavior. And Bollinger Bands can help us understand and identify rare human behavior. This is the monthly advanced decline volume line for the NASDAQ. The chart is dated May 5th, 2021. First thing that jumps off the page, look how strong this was during the COVID plunge. We didn't even get back to the center line, and we're nowhere near, in March of 2020, the lower Bollinger Band. This look here screams strong and secular trend. Also noteworthy, after the sharp reversal in equities in March of 2020, this indicator closed above the upper Bollinger Band, which is rare, for 11 consecutive months. Thus, looking backwards, we've seen rare human behavior relative to risk appetite. Thus, we wondered, dating back to 1982, how many times have we seen at least 8 consecutive monthly closes above the upper Bollinger Band on NASDAQ Advanced Decline Volume? The answer is only 2 times. And like the first study, the copper-gold ratio, these 2 instances occur within the context of a secular bull market. We've covered 1983 numerous times in recent weeks, tying it to the present day. Thus, a 1-year number like this, down 9%, is not particularly surprising if you've been watching these videos. Let's see what we can learn looking at investor sentiment. This is a weekly chart, American Association of Individual Investors, bulls minus bears. S&P 500 shown on the bottom of your screen for reference purposes. Prior to the COVID plunge in the U.S., sentiment was up here February 2020. From that point, not particularly shocking that it plunged in a rare manner as the S&P 500 plunged. Sentiment bottomed after the market, and from point A, sentiment eventually made it all the way back to point B in March of this year. That's where the blue line is on your screen. And if we walk forward to the reading on April 30th, we've dropped back to earth a little bit, moving to point C. Using all of the data that we have, we wondered how many times as a similar A to B to C move occurred, and what happened next in the stock market. The answer is only 6 previous times. And from a longer-term perspective, really good things happened in the stock market, a little bit more mixed looking out 1 year from the date of the signal. Common sense tells us if you're running a business or managing a business and you're very, very concerned about future economic outcomes, you're probably going to be more apt to lay people off relative to hiring them. The inverse is also true. If you're very, very confident about future economic outcomes, you are most likely going to be looking to hire people relative to letting them go. Thus, we can learn something about human expectations about future economic outcomes, by looking at the unemployment rate. See unemployment rate going back to 1976 on the left side of your screen. Using Bollinger Bands for this type of data may be a little bit unconventional, but I think it's fair to say you can see a discernible pattern and a useful pattern on your screen. If we zoom in to the right side of the chart, or the present day, this is 2020 on the left side of your screen. Again, not particularly surprising that we saw a very, very rare spike in the unemployment rate in 2020 during the COVID plunge in the stock market. This black line here is the unemployment rate. This is the upper Bollinger Band here in blue. This is the center line here, and this is the lower Bollinger Band where my cursor is. So when we're above an upper Bollinger Band, that's a relatively rare data point. Same can be said when we're below the lower Bollinger Band. Thus, we wondered, how did the stock market perform after a similar round trip where the unemployment rate was above the upper Bollinger Band and eventually dropped below the lower Bollinger Band as it did in Q1 of this year? In the present day case, the round trip was extremely rapid. In this study, we'll focus on the move from above the upper Bollinger Band and then subsequently dropping below the lower Bollinger Band. Thus, we asked, how many times has something similar happened dating back to 1980? The answer is 5 previous times. If you know your market history, walking forward from 1983, 1986, 1993, December of 2003, and October of 2010, at least from a longer-term perspective, good things happened in the stock market. We've been presenting these results in a composite table because for the most part, they align with everything that we've been talking about and covering in recent weeks and months. That after such a big move, we should have realistic expectations about what could happen over the next 12 months. But like the signals that we've been covering in recent videos, The longer-term outlook looks extremely positive. And as always, to get to the right side of this table in the historical cases, it wasn't necessarily a walk in the park from a volatility perspective. The studies that we just covered, copper, gold, NASDAQ AD volume line, sentiment, and unemployment, there were 14 cases similar to something that just happened recently in either Q1 or Q2 of 2021. The average drawdown from the date of the signal in the 14 cases was 5.19%. The median drawdown was 3.51%. We know the date of the signal in 2021. We also know where the S&P 500 closed in 2021 on these dates. Thus, we can hypothetically project, if we followed a similar path relative to the historical cases, the S&P 500 might bottom somewhere between May 25th and August 31st, and the maximum drawdown might take us back to these levels here. If we put all of this on a present-day chart, numerous things jump off the page. Number one, 10 of the cases, or 71% of the cases, the drawdown from the date of the signal was less than 5%. In the remaining cases, every single one of them jumped to over 10% from the date of the signal, telling us, based on something that just happened in either Q1 or Q2 of this year and relative to the historical cases, there's about a 71% chance, and that's an incredibly approximate number, that the drawdown in the present day, looking out 12 to 15 months, would stay inside of this green box, and roughly a 29% chance that it would move back all the way into the red box. And this is really nothing new. These are the same basic areas that we've been referencing in these videos over the past several weeks and months. 71% of the historical cases, you'd basically bottom either above the March low, above the February low, or basically in close proximity to the January low. And there's about a 30% chance that we would revisit the Vaccine Monday high, the September high, or even roughly the midpoint of this logical area of support here. That's the same basic message that we've been delivering over and over again from a probability perspective. In the cases that we've covered this week, one of the larger drawdowns followed a signal that came on January 28th of 2011. The max draw from the date of the signal was 13.88%. In terms of helping us keep an open mind about relatively muted drawdowns or better than expected outcomes, let's look at the NYSE Advanced Decline volume line dating back to 2004. You can pause your video player here and look at these cases in a little bit more detail, but the point of the exercise is, before the S&P 500 peaked in October of 2007, the S&P is shown at the bottom of the screen, notice how much white space or orange space was between the indicator here and the upper Bollinger Band. And that starts before we peak. Similar situation here in 2010. We're above the upper Bollinger Band in calendar year 2009, and the correction in the stock market doesn't start until the spring of 2010. Once again, indicator with white space or orange space between the indicator and the upper Bollinger Band. And we just talked about the 2011 case in our study table. And once again, there's a drawdown, a fairly significant drawdown, almost a bear market. Peak to trough drawdown was almost 20% in this case for the S&P 500. But once again, up here, you can see between the indicator and the upper Bollinger Band, we've got either white space or orange space. And that's basically as the market's peaking down here. Similar situation in 2015. If we zoom back out, if you know your market history, the S&P 500 peaks here in May of 2015. If we go up here, notice how weak this indicator was, how much white space or orange space was between the upper Bollinger Band and the indicator before this happened. Compare and contrast all four of these cases with the present day. As of month end on April 30th, we closed above the upper Bollinger Band. It doesn't tell us anything about what this is going to look like at the end of May. But what we have in front of us today, you can make an argument that this looks better than the cases that we just covered. Obviously, everything in the market is subject to change. It's very, very possible that we'll see something like this over here. And that may happen soon, but it hasn't happened yet. This comes from Ned Davis Research. Here's their Twitter handle where my cursor is. This helps us keep an open mind. This is an S&P 500 cycle composite. It uses a 1-year seasonal cycle, 4-year presidential cycle, and a 10-year decennial cycle. As always, this is hypothetical and speaks to probabilities. In this case, it's telling us to be open to a pullback in the month of May, and then higher highs, and then really bad things don't start happening until August from an intermediate term peak perspective. Like everything we cover in these videos, this does not represent a prediction. It just helps us understand a wide range of outcomes. This chart also speaks to increasing inflation expectations from a longer-term perspective. This is physical gold relative to TLT or long-term treasuries. This long-term consolidation box, somewhat of a failed breakout look here, Q1 of 2018, and then a failed breakdown look in 2020, a sharp reversal, a bullish breakout, and now what looks like a successful retest, and then a higher high. All of this, from a probability perspective, tends to align with the signals that we've covered this week. This is energy stocks XLE relative to SCHX, which is basically SPY in Schwab form. The bullish momentum divergence here in November of last year for the ratio. You can make an argument that after a very long period of underperformance, we're trying to form an inverse head and shoulders pattern. This would be your left shoulder, this would be your head, and we are trying to form the right shoulder. If we were able to break above the neckline here, the projection would be this point to this point. If we move that up here from the breakout, you can make an argument that we would challenge this trend line here. Even if we can't break this trend line up here, hypothetically, this is still a pretty big move here potentially that could come in terms of outperformance. And this type of look here and this momentum look down here also seems to align with the results of the studies that we covered earlier in the video. This is a setup. It really doesn't mean anything until we have a successful breakout. How about the credit markets? Last week we covered the National Financial Conditions Index, and we basically said lower readings are more favorable for risk assets. Last week it was at negative 0.68. The latest reading that they've published, higher, lower, are about the same. It's actually improved a little bit. It's a little bit lower at negative 0.706, telling us that the credit markets really aren't jumping up and down, waving yellow or red flags yet. And as we all know, credit spreads and credit conditions can change quickly. But as always, they haven't changed yet. We'll continue to monitor this data on a week-by-week basis with an open mind. What can we learn if we look at a chart, a yearly chart of the Dow as of May 5th? Once again, we're using Bollinger Bands. This is the Dow here. This is the upper band. This is the center line. This is the lower band. The basic takeaway is the look of this chart aligns with the secular trend thesis that we've covered numerous times in recent years. So the key takeaway is long term, things still look good. Short term, a little bit more indecisive, with the historical cases telling us numerous paths over the next 12 to 18 months are very, very possible and probable. However, 1 year out, the average gain was still 10%. The median gain was 8%. It's relatively tame comparing it to the rear view mirror, but that's still a respectable return. And if we want to get over to the right side of the table, it wouldn't be shocking at some point in this calendar year if we saw a significant and 100% normal and to be expected give back that occurs within the context of any trend. And I can guarantee you, in this case, this case, this case, and this case, or if the S&P 500 backtracks all the way to this red box here, or even down here, it's going to be very, very difficult to remember that the longer-term outlook remains extremely favorable based on the data that we have in hand today. The signals that we've covered this week, 14 cases, 2 years from the date of the signal, the S&P 500 was higher by 23% on average 2 years later, 47% higher 3 years later, and almost 76% higher 4 years later. And in every single case from the date of the signal and the historical cases, the market was higher. It's very, very easy to look at this hypothetical drawdown chart here and to watch the videos in recent weeks and just decide that we're going to have a give back soon. Well, some of these historical cases here say that's not necessarily the case. The 12 to 15 month maximum draw in these three cases was basically nothing. The market never looked back. And these cases help us with just an incredibly important concept. Experience says, do not get stuck on any story. A bullish story, a bearish story, any story. Markets can do anything at any time. And often, your basic narrative can be right, but it's possible that your timing could be wrong. Another key takeaway about probabilities. Lower probabilities are not zero probabilities. Even if this number was 95% and this was 5%, it doesn't take this type of drawdown off the table. Probabilities help us with numerous possible outcomes. And these historical cases here tell us that we shouldn't get stuck on a major pullback is coming story. Shouldn't get stuck on any story. But for our investment time frame, which is a longer time frame, we really don't have anything in hand that tells us the probabilities don't favor really good things still happening for a long period of time. This is an expanded version of the summary table that we covered earlier in this video. The net bottom line here. In terms of the historical cases, we still have to be open to that upside could be relatively limited. In terms of the average and median outcome for the 14 cases that we covered this week, if we followed a similar path to the average outcome in 2021, it's possible the S&P 500 could peak around 4,300 on June 14th. And as you can see, the median outcome, we really would have already peaked. However, we have to keep in mind, we do have some cases here, 1994, May of 2003, where really good things continued to happen with very little in the way of drawdown. We also have this case from 1986. One of the signals came on August 1st, 1986. If you know your market history, the S&P 500 didn't peak until August of 1987. And between point A and point B, it tacked on an additional 33%, helping us keep an open mind about a wide range of outcomes, including something like this, where from the date of the signal, the market rises and then the market falls. A topic that we've been talking about for a long time. Still have to be open to the probability of gains followed by givebacks. But the weight of the evidence, as we said last week, it still applies. The charts in front of us, we do not have any significant breakdowns at this point. It's a weekly chart of the S&P 500 as of the close on Friday, May 7th. This is a nice intra-week reversal here, and several forms of weekly momentum don't look like a market that's on the ropes. And after the weak labor report and subsiding fears that the Fed may move very, very soon, we had one of the best sessions that we've had in several weeks in terms of evidence of risk appetite. As always, we'll head into next week making no assumptions about how long the present day charts hold up. They may break down very, very soon and very, very quickly, but we haven't seen breakdowns yet. And we know we don't trade historical studies, we trade the charts in front of us. And the best way to do that effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.